All right, let's get straight into it. Let's have a look. All right, we're going to be looking at EJ. We're going to be looking at US 30 and GBP NZD. We'll be looking at some of these pairs today. We're going to start off with GBP NZD. I'm going to go and check them out. Hopefully my background music is exactly that. It should be background. We are live. All right, cool. So let's have a look and see what is going on here. All right. Interesting. All right. So I'm going to delete everything off my charts. And we're going to have a look at this market on a bigger picture. We know that first and foremost, the very first thing that we must do is zoom out to the bigger picture. But what I want to do today actually is, in fact, what I want to do today is I do want to go back and start having a look at some of our sessions, letting you guys understand something that they call AMD. All right, now AMD is describing accumulation. It's describing something they call manipulation and something they call distribution. All right, big words for some stuff, but essentially the market going sideways, the market grabbing liquidity, and then the market being distributed into a direction. Okay, so that's ultimately what we're going to be discussing and going through today, but in line with what we do, in line with our strategy, understanding exactly what the markets do and don't do. All right, now for this, what I want to do is I want to also link this. All right, I want to also align this with understanding sessions. Okay, because more time out of 10 these things are happening in certain sessions. Now, if you can see, I've just triggered something called kill zones. You can find this also in your indicator list. It's called kill zones. All right. Now, those kill zones, the reason why I put them on is that they, give identifiers different sessions. And for the people that don't know, this red session is our Asian session. Yellow is our London session, and white is our New York session. So let's explain this for the people that don't understand what I'm talking about. For people where this is a little bit alien to them, these colors are relating to the different sessions that exist in the markets. All right. Now you can see a hard, thick line, and that line ultimately, this person that created this indicator wants to identify that area there. All right, that hour or so as a kill zone. Okay, now I'm going to remove that for now, so I don't necessarily want to focus on just those little power hours. Let's turn off these kill zones. Turn off the kill zones. Turn off the kill zones. All right, now what you're left with is sessions. Like I said, red. Let me try and hide this. Red is Asian. Yellow is London. White is New York. Now you can see a couple times them overlapping. That's because sessions overlap. Now going back to our AMD, which I'm going to write again on the screen. A for accumulation. All right. M for manipulation. D for distribution. Okay. Now, to be fair, this is exactly our strategy and things that we look for, just fluffed up, put in a larger time frame. And in this instance, we're going to be looking at the sessions. Now, normally, typically, in an Asian session, we have US controlled pairs accumulating. Oh, that's definitely not spelled correctly. Let's get rid of that. Accumulation. It's my big fingers. Here you go. Distribution. All right. So typically in an Asian session here, we have, and I'm going to put in because I do have these as little safe thingy-majiggies. So in regards to here, this here would be our Asian session high. Okay. And this here would be our Asian session low. Okay, does everybody understand why that's the Asian session high and why that's the Asian session low? Everyone should understand. Does anybody not understand? You should understand. It's this red section that we're looking at, and this is the highest point, and this is the lowest point of that section. So that you know, that's approximately like 11 o'clock to like, you know, kind of 7 in the morning, around that kind of time. From about midnight, yeah. It's around that time. All right. It's nighttime. It's when you're sleeping. It's Asian session. All right. So then that is the Asian session high and Asian session low. And what we look for in the next session, which is this yellow session, all right, is some sort of manipulation. Okay. The market was manipulated up here. And within that session, we've seen a push down. Okay, so within that session, the market was manipulated, ran in the opposite direction, and then ultimately we're looking at distribution. And then the market from this point here gets distributed higher up into these levels. Okay, so what is this? How is this helping you? Well, this is helping you by basically giving you a little bit of a plan, a playbook. We've gone over this multiple times in the past, of being able to look for when the market is going sideways. Yeah, now there's a few things you could have done. You have the tools. You have been taught by me how to take this trade from here for the sell. Yeah, you've also been taught from when this market has, whenever it breaks structure, i.e. Eats up some liquidity, that we're expecting to see markets to run the other way, and how we could potentially get an entry around about here and here. So let's try and see if we can identify those entries, because you know, if you get in here and the market is breaking structure nicely, there's a very high possibility the market will continue and distribute higher because of this AMD model. So these two little X's, let's see if we can find the entries on a smaller time frame. All right, so I'm going to jump all the way down to our 5 minute. I can't bother to make it take a week. All right, so those two white lines were showing us an Asian session high and the Asian session low. Okay, when the market pushed up in here, have a look. The market, there would have been no reason why we would have gotten in here. Let me draw this now properly. Now we can zoom in a bit better. Okay, there'd be no reason we would have been in here for the buy, because we didn't get an indication correction. We didn't get a continuation above the high. This is all some wick stuff. We didn't get a continuation, so it wouldn't have been in for the buy. So anybody's out here said, well, we would have looked, it broke out here, would have been buying it. You know, you wouldn't have. Okay. Now, unfortunately, in here, unless I struck to my very small time frame, you probably wouldn't have got this move down here. This is quite a quick push down. All right. It's a quick push down, but have a look. If we were to draw some lines in, this is what our lines would look like so, touching the highest point, touching the lowest point before this highest point here. Yeah, and then you'd be looking for some breaks of structure. Now, unfortunately, like I said, on 5 minute, we can't see it, but I'm going to show you the entry on a smaller time frame just so you can see how fractal our strategy is and how it works on every time frame. And bearing in mind, this isn't one I made earlier. I wasn't up all last night preparing this session for you guys. I'm just looking at these sessions live and trying to analyze them, try and see where I could have got in or out. All right. So in this instance here, for argument's sake, look, me drawing these lines like this. All right. If I was to draw another line, it'd probably be like from here to here. Why? I'm on a smaller 1 minute time frame. Why? Because it's taking into consideration this lowest point before this highest point over here. Okay, this point here is higher than this point. All right, so therefore this becomes some structure. Look, the market went like this, then went like this, then went like this. All right, now if we take that as a low, well, ultimately we're waiting for a close below this low. One happened here, it was very tight, and then we're waiting for a retracement. Okay, one happened, if you want to say it retraced, kind of, you could say this is a retracement, and this is the closure down below. Now you could have taken this trade with your stop here. If that was the case, you would have got stopped up. If you took this trade and placed your stop a little bit higher, which would have made more sense, because on a swing high, you would have been safe. That could have been an entry to get into that fast moving move that happened here. We don't know why this market kicked up as far as it did. Maybe some manipulation, but if we take the strategy and understanding what I tell you guys of, there is a higher risk entry, which would have been here, plus your spread times 2. Let's have a look. I'm trying to say that you might have still been in, maybe not. All right, that's the higher risk entry. This has been a safer entry. Still 15 pips. I would have liked to have thought that maybe I would have taken the safer entry as it's only 15 pips and then this qualifies you above this swing high. That would have been the only way you got into this move. But when you saw it sweep the Asian lows, all right, at that point in time, we've broken structure. Have a look. If I get out of 1 minute, go to 5 minute, 15 minute, wherever we was at, we've swept the Asian lows now. The market's been manipulated up here, come down here, swept the Asian lows. I would be keenly looking at this market to see what it does. So I would be protecting my position. What does that mean? That means moving my stop to a point whereby I cannot lose and hopefully I can win. What does that mean? That means hopefully I'm going to make some money from moving my stop, but definitely I don't want to lose. So for argument's sake, I might have been like this, moving my stop, all right? When this market came and it kicked down on it, and I probably would have been stopped out by this little pushback up in here, all right? If you want me to be totally honest, okay? It probably would have been pushed back out, stopped out, sorry, by that kickback. In fact, yeah, by that kickback there. But to be fair, I'm going to be honest with you, look, even though we've seen all this wick, I would have been, there was a closure here, all right? So I would have probably been squeezing up and I would have been stopped out here for some profits. I'm happy with that, I don't care, all right? Now the markets came and closed some imbalance, had a little think about it. So it over here, when we're looking for indication, correction, continuation, the market actually didn't do it. This little push here, the market actually didn't indicate correct and continue, because look, when I'm looking at, this is the 1 minute, by the way, I don't want to go any lower. Structure for me is looking at potentially maybe there's some structure here, and that market didn't close above here. It only wicked up here. The first closure was actually up here, and then it didn't correct and continue. It just dumped off. All right. So at that point in time, have a look. This would be the closure now. Bearish. But am I in for the sell? No, because it didn't correct and continue. It came back up here. It's ultimately ramping and trading within a range. Yeah. What is that range? Have a look. That range is between, if you want to go there, this high and around about this area here. That's the range. Okay. So I'll tell you when I would have got in the trade. When that market indicated, corrected, and continued outside of that range. Have a look. Maybe here. Obviously, this is the 1 minute time frame, which we are a bit small. But that would have been a very aggressive 1 minute entry. Let's see what would have happened. Would have been stopped out over here. Let's get out of this 1 minute. I would have been. It's not a problem. Like I said to you, 1 minute. That's what you're asking for. In fact, let me go again on a 1 minute time frame. I wouldn't have been in that 1 minute trade. I'll tell you, okay? I'm gonna explain why I wouldn't have been in that 1 minute trade. And this isn't a hindsight, it's just the reality. I'm doing this quick. Is me placing my stop underneath these little lows here makes no sense when I can see underneath here all of these green. You might as well say this red candle in here is a green candle because it didn't do anything. These green candles, I would have definitely zoomed out and I would have seen that below that level was what? What would I have seen that below this level where
imbalance.
And I would have said that I want to at least take into consideration that imbalance. So whether that means I put my stop here, taking into consideration to the millimeter, or I said, let me just put below this swing low, I would have done that. Why? It's only, what's that, 6 pips? That would have been my entry. Yeah? And if that was my entry, this little wick action that came and tapped into where? The imbalance wouldn't have bothered me. I'd have been nice as this market continued to push up in the direction and is still in profits, what got up until a 1 to 2. So what have we learned from this example, which it was just an example? Like I said, it wasn't one I made earlier. We've learned a few things. First of all, we've learned how the Asian session and the Asian high and the Asian low create some sort of zone, some sort of that we can pay attention to. And we can start looking at and see what happens when we break those levels. Are we just sweeping the liquidity with wicks? Are we starting to take liquidity and break structure in the direction and then thinking to myself that we might get some distribution constantly in a certain direction? Secondly, we've seen in here that when we're going to enter any market, we must look left and right like we're crossing the road. Yeah. So if you're in a 5 minute, maybe you look on the 15 minute. If you're on a 1 minute, maybe you look on the 5 minute. Wherever it is, and make sure that close to us we cannot see these big glaring concerns, because the market has a wicked tendency come and make your concerns a problem. Yeah, these little look at these wicks from nowhere. Like, why bring this wick here? Why let this wick exist? Why? Only for one reason, is to tap into these imbalances and to clear out people that had, you know, some tight kind of stop losses. All right, so that's what we've learned from that example. Let's go and try and see if we can learn from another example. I'm gonna put my kill zones back on. I'm gonna wipe the charts, and we're gonna go and look at the previous kill zone. All right, so our previous Asian session. Let's try and see it here. So have a look here with this red level here. Okay, let's get this out of the way. I'm gonna put a line over here. Why? Because that line becomes Asian session high. Then I'm gonna put a line all the way over here. Why? Because that line there becomes the Asian session low. Why? Because we're in this red box is what we're doing lines within. Okay, and then we start to see when the next session starts up, some manipulation of this market being pushed in a certain direction. Now, obviously, we have the ability to trade this because this market has, in this session, indicated breaking previous structures, corrected and continued. Don't get it twisted. You have the ability to have turned around and been like, yeah, Jay, I'm not gonna lie to you. I traded that London session pushed down. Okay, but as soon as we started getting to the New York session happening, it's like the market wanted to do something else. And soon as if I was in that trade and I'm seeing everything going really, really well, coming down here, why did I draw my line like that? I have to touch this last high before this lowest point. If I start seeing the market start breaking those levels, well, I'm out. I'm not going to still be in that trade. I'm going to take my money. I'm not only going to take my money, I'm also going to be aware that in the next session, which is the New York session, this white session, the market can have a tendency to distribute back up into these levels. So I'm aware of these things. So taking my money here, especially when I've seen structure breaking, makes sense. Let's go again. Let's go again. All right. I'm just going to try and find one that's more, you know, textbooky. All right. So some people say this: what if the market in the Asian session is trending? And if the Asian session is trending, then you just shuffle things over. You know, maybe in the next session it's going to consolidate, and then after that it will manipulate. You understand what I'm saying? But the easiest way for you, it's like if we go to another pair, US 30, the easiest way for you to look at this is to first and foremost find the consolidation. In my opinion, finding consolidation anywhere is a great way for you to start your flex, to start your move. Just look for consolidation. Look for an area where the market is thinking about something. All right, because that's the time when the market is gathering. Look at it, for example, here. Look, I'm looking at this on the hour time frame. The areas that my eyes are drawn to, which your areas your eyes should be drawn to, are the times when the market's doing this. It's just my eyes are just drawn to these areas here. Because to me, it's getting ready to do something. That dance is about to start. I don't want to get there to the middle of the dance or the end of the dance. My eyes are drawn to these areas. Now, for argument's sake, let's imagine my eye was drawn to this area over here. I'm on an hour time frame. It's not even that big of a time frame. I'm on an hour time frame, so my eyes are drawn to. Out of that time frame, what am I looking for to potentially see an opportunity for me to get into the trade? What if I see this consolidation, this market going sideways? Obviously, this is just an example. This is obviously covering a few sessions, but just generally, if I get rid of these sessions here, for argument's sake,
what are you waiting for? A break of structure?
I'm waiting for a break of structure, and what do I call that? What is the easier way that we abbreviate it? An indication. So here on this 1 hour time frame, I can drop my time frame down. Have a look at 15 minutes. Hope it doesn't move me off the screen too far. 15 minute here. When it's 15 minutes. I'm simply sitting here looking at this consolidation and waiting for what I wait for. Remember, I said to you, you guys are allowed to go down as low as 5 minutes. Let's do that. I say you're allowed to do whatever you want, but it's just me saying that safest place for you. Have a look. This market was here. This is all wick action, but when we got a closure here, okay, this is now into indication realms, and it keeps indicating for a few candles. Then it corrects. Then it continues and closes here. This is a clean closure. There you go. You took that trade. There's a nice quick one to, I don't know where it went to. Oh, went to hell. Okay. Then you're laughing your head off. Even again, when that market starts to consolidate over here, let's have a look at that consolidation. Market comes down here, starts doing a little hokey-dokey in here. Now, we probably not going to be able to see it, and I really can't be bothered to drop to a 1 minute time frame. But, you know, we're looking to see where this market indicates, corrects, and continues to. If you're already in this for the sun, it just indicates and keeps going down here, and then corrects and continues down here. Well, by all means, you're even more live that you had such a massive, indication leg. All right, have a look. The market came down here, started doing the hokey cokey. In here. Maybe you realized it doing the hokey cokey about here. Started doing the hokey cokey. Okay, no problem. So what do we do? What are we sitting down waiting for? Somebody tell me. What are we sitting down waiting for? Some sort of indication, some sort of correction, some sort of continuation. Now, in this instance here on the 1 minute time frame, we might have thought this was the indication here, closing here, and we would have been waiting to see it correct without breaking previous structure. If this starts to correct down here and breaks the previous low before the highest point, which it did here, well, that we're not just waiting for the correction to hit the button. We can't. It's void. We're waiting for another indication, correction, and continuation above this level. See it? So we're going to be waiting for something to happen over here. Some sort of indication, some sort of correction, some sort of continuation. And it's here. This is the first time, look, above this level here. Maybe you can't see it, but I want you to see it. If I do a line like so, maybe the first clean candle that closes above that level is this guy here. Let me put a little arrow in. If I can find my arrows. More than likely, I'd say it's this guy. This one in here. And then we've seen a little correction. This is a correction. Yeah. And then we've seen a continuation and a clean closure as a probably here. And you could choose as an aggressive trade to be like, that's my entry, my stops here. Okay. Or you could have placed your stop all the way at the bottom, quay down here, which I wouldn't have bothered doing. All right, which I wouldn't have bothered doing. Another thing that you would have been able to understand is you'd be able to see the angle that this market is trading up within. That would have been your angle. So placing your stop below that trending angle makes sense, right? You're not in here in the trend. You're outside. You're like the price is broken outside of the market. That would have been your aggressive entry stop. And the market came back up here, decided to go sideways. At this point in time, you're a bit concerned. The market is going sideways. Let me try and look at this on a 1 minute time frame. I'm going to try. Hopefully it gives me information. Hopefully it gives me the information. Where was we? Where were we? Okay, over here. Yeah, market starts to go sideways in here. You'd be a bit concerned. You may have even drawn yourself a little box like so. And to be fair, there isn't a clean. Well, maybe there is. Have a look. This closure over here, this candle here, if you can't see it, it's this guy. Is a clear closure over here. However, when it came back down here, it started to break minor structure. So the 1 minute's not really giving us what we want to see here. Yeah, it's not, because it broke some minor structure again, which made it void. Either way, you'd still be in the trade because it broke in your direction. I'm not trying to say that somehow you wouldn't be in the trade if you got in down here. But I'm talking about if you didn't get in there and you was trying to get in from this little energy, the market kind of fraffing about a little piece. Okay. What I could say is this. On a larger time frame, there is a candle there. All right. maybe on the 3 minute, maybe not even on the 5 minute. Well, look, you know, you can look at it like this if you wanted to. This is 5 minutes. Here you got in, the market pushed up, it's just making, it's going kind of, no, you can't see it in the 5 minute. Yeah, but either way, you'd have been in that trade and you would have been nice. It is there on a smaller time frame, maybe the 3 minute. All right, let me try and find it for you so I'm not, you don't think I'm waffling. Maybe 3 minute or 2 minute. All right. This here is a clean closure on the 3 minute time frame, the same candle I spoke about. Yeah, the previous low here, have a look at the structure. Up, down, up, down, up, down, up. So therefore, this would have been your indication, that clean closure up here. This would have been your correction, not breaking previous structure over here. And this candle closing over here would have been your entry. You would have been able to, if you were savvy enough, to catch just before it exploded. This is an aggressive stop below your last low. Could have gone below here if you wanted to. Probably I wouldn't have, because it's below an area of liquidity. You might decide it wants to push down some more. So I probably would have been behind below here very aggressively. Spread times 2 below here, and that could have been your entry, catching a explosion in this direction. And here you would have stayed in this trade until it indicated and corrected and continued against you. Or if you was happy with your profits, as a 1 to 5, if you're happy with 1 to 5, take your money. If you can see structure to the left where it looks like it ain't gonna get through there, by all means take your money or at least protect your position. But look, this market here it indicates here definitely breaking some minor structure. But when it corrects, it does not continue in this direction. All right, it actually comes back up here, goes sideways some more, pushes up some more here. So if you're watching this keenly, you're waiting for any excuse to get out of this trade. You can see the market here going sideways, maybe a slight indication here, closing below this little level here, corrects, doesn't continue, continues going sideways, continues pushing up, gets even a little bit higher up in there. Fantastic. Now we're getting very, very tight. Yeah, and it's a bit difficult to see here, in my opinion. You're getting very difficult to see, but possibly this is structure, and maybe this is a little indication below this structure. Maybe this is a closure. Get out. Get out. You'd have been good to get out, because then the market started to do this. Market tapped in here and then started going against you. Perfect trade, perfectly went out. But in reality, you might not be able to be here to see this structure happening. So therefore, you was happy with your 1 to 5 or your 1 to 6, and you was like, bro, I'm taking my money. And by this time anyway, I have taught you that you would have definitely made sure this is risk-free. You would have definitely been securing in your profits at least 1% at a time. What do I mean by that? Boom, when you get to your 1% of your account, secure that in. When you get to that 2%, secure that in. When you get to that 3%, secure that in. When you get to that 4%, secure that in. Yeah, because when that market kicks back on you and you was up here at 5%, here you was up at 6% up here, but it stops you out here at 5%, you're still over the moon. You still had the great day. You have a shit day when your stop was over here. Because you was being so greedy because you thought you was going to go for a 1 to 10, you didn't want to stop yourself out, and then the market goes, yeah, and gives you £1 on a position that you was up 5% in your account at one point. Trust me, people do it because they like, oh, it's gone now, it's definitely gone, it's gone to the moon. Yeah, and trust me, people take L's or break even and think to themselves, oh my gosh, why didn't I take the money when it was up here? So a strategy for you is bank that money 1% at a time. If you've got a 100k account, you're at £1,500, move that stock to £1,000. Get up to 2,200, move that stock to £2,000. If for whatever reason God's with you and it goes up to 3.5, move that stock up to £3,000. Especially if you're looking at structure also, and you're using the confluence of seeing certain structure, imbalances, whatever it may be, to be able to say, no, this market's going to push up or not. But just as a raw strategy, do not let, money the markets kick back on you when you're 1-2% up on your account. Understand how to secure some money. Let's get back to what we were saying in regards to AMD. Accumulation, sideways action, manipulation, the market's pushed in a direction to grab liquidity, and then distribution as the market starts to trend in a direction or go, push in a certain direction. So we're going to pick a different pair again. Let's put GBP USD. Let's have a look to see if we can again see these different cycles and phases. I'm going to do it easily or quickly by using this kill zone tool. And we're looking for, like I said to you, let's look at this example here for argument's sake. Let's just put this in as the Asian session high. Let's put this over here as the Asian session low. Oh yeah, in fact, we've already done this one on, I think we already did this one. I feel like we have already done this one, so it's familiar. All right, let's go to present time. Let's get rid of this stuff here. Let's go to present time. And let's go to present time in a few pairs. So we're gonna go to present time, and let's look at something different. Let's look at gold. See what gold is saying. He's saying, man, let's have a look at gold. All right, see what it's saying. All right, so gold's frothing about over here right now. All right, and we did see a push up in his old, in this. Let me get rid of these kill zones for now. In fact, let me leave him. We'll try and use him. All right, and then you delete everything off this gold chart. Looks like it's a bit messy. Okay, so let's zoom, and I wouldn't be doing this in isolation, guys. This is one thing. I would never be doing this one element in isolation. I would still be opening my charts like I show you every single day and be identifying what's going on in my Russian dolls, be drawing in some lines. And you can draw your lines much better than me, guys. I'm not the neatest drawing my lines, especially in the morning when I'm just teaching you guys. I'm just kind of slapping in it. You can get very neat. You can start fading them out so they're not as, imposing. You can start doing lots of things to make your charts pretty. Maybe you want to do this on a Sunday. Remember, you're not necessarily deleting and redoing your markup on your technical analysis every single morning, like I'm doing. You don't have to do that. You could give it a good old, once over on a Sunday and say, yeah, I'm leaving that there for the week. I don't need to be doing this 50 times a day. Like, I don't actually have time for that. All right. Obviously, I'm teaching you guys, so I do it over and over and over again. But realistically, I don't need to. You don't need to. All right. So let's drop down to our daily chart. So that's us understanding. So say, for example, what I mean by you might fade some stuff out is, look, all of those lines that I've drawn in here, they are kind of taking up a little bit of eye space. They're taking up a little bit of eye space. And what I could choose to do, let me choose to do that. Okay, I can't fade them all at once. So I'm going to do it one by one. All right. So like so. I can fade this up like that. 20%. I can put everything at 20%. Everything at 20%. So I know that this is my kind of bigger picture. I can leave some ones that I want more prominent. I can make some ones a little bit darker if that's what I want to do. Yeah, and this is something, like I said, you could do on a Sunday on the basis that it's done now, and I'm not going to do it again. Yeah, and see how the week works within the things that you've drawn. Okay, so over here I can see these bigger ratios. Now when I drop to my daily time frame and I start actually drawing some bit tighter lines in here, or some more analysis, then maybe I might choose, because it's a more relevant, more recent, to maybe give that a little bit more strength. Yeah, so like I said, you can take pride in however way you want to mark up your charts and when you're going to do them. Okay, that's down to you. All right, so I'm just going to slap some lines in like so. All right, so I'm looking at this last little energy here and I'm thinking to myself, okay, let's see what's going on here. Let me see Wagwan. All right, the market pushed up within this range as terribly as I drew it. The market kind of pushed up within this range bullishly. Boom, come up here, broke a little bit of structure here, but continued to push all the way up to the point where it actually pushed a little bit up above that high. This is the last high now. Okay, now we know gold is a bit of a unique one on the basis of it's used as a kind of a safe haven in crazy times. And unless you ain't noticed, it's crazy times. All right, there's always certain crazy times happening in the world. So there's a lot of fear and reason why people might be, pushing this gold might be continue to push and push and push. All right, but we see that on a smaller time frame here, the market came up to this high. If I was to draw some more lines in here, which I'm going to do, the market pushed up here Like, so at the moment, the market is trading within a range. The range it's trading within is this box here. Kind of here. Even though there was some wick action over here, we're kind of still in this energy between this high and this low. All right, we did see this little wick action here, and it might even be a little closure on a larger time frame. I have to check. But at the moment, we're trading within this range. So right now, where are we in the range? Slap bang in the middle of that range. Can't lie to you. All right, we're slap bang in the middle of that range, and I don't really like middle of the ranges. I get a little bit, you know, panicky in the middle of a range. All right, we can see the market came down here and that got to middle to more say like the lower third, and started kind of frapping about a little bit in here. All right, I do not want to get involved in the gold fraff at the moment. It does look in our bigger lines that we put on our chart that we might be at the top of this yellow range and might decide to come back and somehow touch this yellow range. Now that doesn't mean that it's going to go like that. All right, it could decide to just do this and get to that yellow line before it decides to go this way. All right, but I'm not overly excited. Yes, I like the fact that we broke outside of this blue range, this previous blue range. We've broken outside of it. I do like the fact that it's done that. I'm just a bit concerned that we're in the middle of this bigger range. Right now, this could be a little bit of a liquidity grab above this sideways action. And we actually might see this market, or like I said, manipulation. We might see this market distribute in this direction. All right, could do, yeah. However, I just don't love where we are positioned. If I drop my time frame down to an hour, we can see some structure in here of higher highs, higher lows, higher highs, a little bit of a sideways reaction on high. Now, if I have to draw some lines in there to keep me balanced, my line's gonna have to look like that. Getting the general energy of the move, but definitely making sure I'm touching some data points. This last low for the highest point and the previous low, so I can get an angle. And then look, that would be the range that market pushed up in there with it. So even if it starts coming down here on a 1 hour time frame, this would be the structure. Yeah, on a smaller time frame, we might get a little bit more insight. Have a look how the market has broken this structure here, the closure here. Oops, the closure here, indication there. Now, if I was really keen, like I said, if it wasn't in the middle of the range, I might be saying to myself right now, when I get a closure, that maybe I want to do that on the basis that this market is grab some liquidity and it's going to push down here. My concern is it might just come down here to close this imbalance and then decide it wants to go higher. So as soon as it started pushing into this area here, I'd probably be protecting my position. Just at least trying to say, you know, I don't want to take an L on it, or I wouldn't be involved. Yeah, or better still, we're going to wait until the market actually breaks straight through this imbalance and starts doing something, breaking some structure here. Now, if I did, which I'm not saying is my top of the list trade, no, I'm definitely not saying that. But if I did get involved, you know, I'd be looking and thinking to myself, like, are we going to get down to at least like a 50% level of this sideways energy? So about down to here. So I'll be thinking to myself, and if we do just hammer straight through there and start pushing down there, well, great. Then maybe this means that this market, have a look on the bigger picture, our bigger Russian doll, that this market came down here, had a little think about it, did a little nam liquidity grab, and it's going to continue pushing down towards that lower discounted area, which in this instance is here, these yellow lines. Let me just see what that white line is over here. Yeah, it's those yellow lines. Okay, but I don't necessarily love getting involved here in the middle of this yellow box. It's a bit, yeah, it's a bit leave it. Yeah, it's a little bit leave it. All right, let me go and have a look at another pair, or a pair you guys want me to look at. If there's a particular point, just shout it out and we'll have a look at it from a technical perspective. But we'll also, let's have a glimpse over here as we do.
Can we maybe look at Bitcoin, see what Bitcoin's doing at the moment?
Yeah, we can definitely look at BTC, see what going on. So today, guys, we have lots of red folder news. I know King Louis knows about this red folder news and what's happening in the world. It's down. If you'd like to give us some insight, that'd be fantastic. So man, no, I don't watch news. I only wait for my Alan update.
Grand Rising. Grand Risings. Been a little while. I've been up to Leeds and back for work and so on and so forth. So
Amazing.
yeah, it's
Hectic.
yeah.
No problem.
Anyway, yeah, it's been hectic. It's been hectic. However, I've tried to jump on when I'm on the tube. And then when I come off, I'm obviously getting off on the station. Grand Rising all again. Yeah, there's a lot going on. I don't know if you see what's going on in the world at the moment, but AI still shooting the market up. And also a lot of these central banks are looking to cut interest rates.
You're cutting up a little bit, King Louis. You're cutting up a little bit. I know you are traveling. It's sounding a little bit robotic. Al, you're a little bit choppy at the minute, Al. I don't know if that's just for me or is anybody else getting out like a robot.
Nah, it's choppy for me as well.
Al, you're a little bit choppy at the moment. He can't even hear. Al, you're losing you, Al. They're trying to get you.
5% off. Can you hear me?
Man,
Nah.
it's out of order because the robotic, you see the choppiness made it go, mate. Yeah, we know you don't talk like that. It's choppy. It's a bit choppy at the moment, Al, where you are. See, I think he's put a message in. Give him 5, no problem. Guys, we've seen about Trump. You know, Trump's been indicted, convicted. Yeah. I don't think this is a good thing for the United States dollar personally. I think it makes them look weak. Yeah. And he's going to appeal it anyway. And he's probably still going to run anyway. Okay. So it's like, it's just disrespect. You point like, we can look at the Dixie and try and see what the Dixie's doing, etc. But like I said to you, what I did want to do this today, which we've gone over, is letting you guys, let's add this in there, sorry. Letting you guys understand about this accumulation, manipulation, and distribution model. Al, you back?
Yeah, I'm back. Can you hear me?
That's it. You're a bit more crispy now, for sure.
Yeah. Okay, as I was saying, lot going on at the moment. Regards to, yeah, I heard about Trump. That's another thing I'll touch upon. We've got a lot of the central banks. They are cutting interest rates. We've got Bank of Canada on Wednesday. They cut interest rates on Wednesday, 0.25% or 25 basis points. That was done on Wednesday. We've got the ECB, the European Central Bank. I believe they're going to cut interest rates as well to by 0.25%, 25 basis points. That's at 1:15. So there's going to be a lot of euro volatility today.
Let me jump in Al quickly and ask you a question. So, you know, the cutting of interest rates for people that don't know, and what typically effect does that have on that currency's price?
Well, it kind of will weaken the currency, especially if the US dollar, for example, the US cut interest rates. It will weaken the currency against the G10s, and it will the indices will fly, and all the other currencies will fly. So it does weaken the currency temporarily.
So give us more breakdown. When the currency weakens, why does the indice fly?
Yeah, because their costs it becomes cheaper. Yeah, the currency is weaker. I.e., the US dollar, prime example, obviously is the number one currency in the world. If it's high, the export costs are expensive to other countries. If it's low, yeah, then because the bottom line is everybody around the world, when they buy goods, even in this country, they use the dollar. So if the dollar's expensive, yeah, the costs are higher. The dollar's weaker, the costs are cheaper. Yeah, that's the best way to break it down. So what will happen is these companies, what they will do is their costs will become cheaper if the dollar is weaker, especially for their exports. Yeah, right. So that is the best way to explain it. When the dollar is very expensive, all your costs are really expensive. Dollar's weaker, it's your costs are, you lower your costs for the for everybody internally and externally, i.e., when you're buying goods, your goods should become cheaper when interest rates are down. But when they're up, everything becomes expensive. Yeah, that's the best way to explain it. Yeah.
Okay, and when a country has lower interest rates, are they more attractive to invest into, or are they less attractive to invest
straight
in?
away, yes, they are more attractive because it's cheaper. The yen was attractive because the
But
yen
not necessarily
was
the country. I'm talking about the actual currency. Is it
yeah.
Is it better for me to hold dollars when the interest rate's low or high?
If the interest rates are low, it's better for you to be selling your dollars. Yeah, not holding on to your dollars. If the interest rates were high, that's when you're holding on to the dollars. Yeah, you got your dollars and your dollars. I think that's the best way. Let me rephrase that. If the interest rates are high, yeah, right, as prime example, everybody will come to Europe because the dollar against the pound and the euro, the Americans, is weak. So their spending capabilities is stronger. Yeah. If the dollar is weak, then you won't get much Americans over here because it becomes too expensive.
Okay, so yeah, I'm definitely just making like fishing and making you explain it for people,
That's
because
all right.
it is quite straightforward, but it does show how everything's interconnected. Ultimately, if a country has very, very high interest rates, well, obviously the actual currency itself is you'd like to hold that currency because you're getting more and more interest. Okay,
that's correct. Yeah.
However, that expensive currency now has ramifications for domestic companies, because now things that you want to buy from that country have also become more expensive. Like you said, your costs have gone up. Okay, so there is that dynamic that if for example the pound, you're getting great interest rates, you're like, well, I'm going to leave it in my savings account.
Yeah,
I'm getting such great interest.
That's right.
But at the same time, anybody else who's coming over to this country, is what I was basically saying, is going to be like, the pound's really expensive. I'm feeling poorer by going there. Let's not go there. Let's go to Greece, where we're going to feel like millionaires. All right. Guys, give me 1 second, guys. Give me 1 second. All right. Sorry about that. That's when mommy turns up at the house. But yeah, so very good explanation, and it's really important that you guys try and start understanding this way all these like the world's interconnected, like these different things are connected and they have ramifications.
Yeah, Jay, let me just interject there quickly. You're absolutely right. We saw a lot of American tourists came here when the dollar was strong. Yeah. Basically, you maybe you know this or you don't know this. All UK companies, yeah, buy goods using dollars. Yeah, they don't buy it using pounds when they're dealing with all countries around the world, yeah, all suppliers around the world. They use dollars, right? So it does have ramifications on us in regards to goods in the store, right? It makes it cheap or expensive, right? The other fact I wanna say, we got non-farm payroll tomorrow, right? Very important non-farm payroll, yeah. We had some jobs data, which was kind of weak. So the Americans, they talk about recession again. So, if there is a recession, because markets are all-time highs, where you got it, you heard it here first, yeah? You probably can't see recession, but if you look at the data, it's pointing towards it may be a recession in the United States. If there's
what defines a recession? Like, so
2 quarters of negativity, 2/4 of negativity GDP rate is a recession. That's what the definition of recession. Yeah, there you go. Yeah, right. The other thing is Trump. You mentioned Trump, Jay. Trump has said that if he gets into office, he's going to sack Jay Powell and he wants to take over the Fed himself. That's a big mistake. You know, if he does that, inflation's going to fly high. Yeah. It's going to fly high. I mean, you touched upon, you know, the criminal conviction. I mean, end of the day, you know, it's all about due process for me. If you know, everybody is supposed to be equal under the law. Unfortunately, it's not like that. But, you know, it's these cases should have come years ago. I don't know why they're coming now. Well, you do know why they're coming now.
We know why they're coming now. They're coming now.
We know why they're coming now. However, they should have happened, years ago. Yeah. Mm-hmm. Right, for due process, right. Mm-hmm. But the issue for Trump is if he gets into power, he's just going to be like a vigilante, right. And that is not good for the world economy. You know, as far as I'm concerned, you know, they've got the two people they've got running for president shouldn't be running for president.
I think it's really, I think it's proper. I think it's interesting because I actually think that the world is so on its head. I think the anarchists of this world want Trump in there to see, like, you know what, let's have somebody in there go and shake it up a little piece because it's mad. Like you said, who else is running? Like,
nobody.
Look at the rest of the candidates.
Yeah,
so you're choosing between bad and ugly.
Yeah, it's shambolic. And as far as I'm concerned, he's going to sack Jay Powell. That's one of the first things.
Yeah, I don't think he should have said that. I don't think he should take the angle because I think Jay Powell is generally liked. What do you think? Is that
I think Jay Powell's had a steady hand, to be fair. He's had a steady hand. Not some people don't like him, which is fair enough. You're gonna, he's Marmite to some. However, I think the Fed haven't done a bad job. I think they were too slow at the start, but they've kind of steadied the ship, and I believe if the jobs, as I've said this to you a couple of years ago, Jay, if the jobs market, employment start trickling up to 4%, you'll get an interest rate cut, because they can't allow unemployment to get out of hand. So watch that space, everybody. Jobs, the CPI, not CPI, the non-farm payroll is going to be really important tomorrow. CPI next week. CPI comes out the same day as the Fed next Wednesday. So that's going to be a very volatile day next Wednesday. The volatility is going to be mad next Wednesday. So it's either you stay on the sidelines or you just be very, very careful next Wednesday.
Let me move this conversation forward, and I'm going to talk specifically to you there, Al, if you've got some time. So
I have.
In regards to, look, we can see that there is news every week. There's news. There's always a CPI. There's always a new non-farm payroll. There's always a new whatever it may be. Now, we have a dilemma, and the dilemma is that you're starting off in your trading journey, and we're trading Forex. I tell you why Forex is so popular, because it's cheap to get into. You can get into Forex for very small amounts of money. However, Forex is a derivative market. It has great volatility, and not a lot of people, or it's difficult to day trade. Okay. Now, what do I mean is difficult to day trade? I mean, if you was investing in stocks, you're just buying and holding. We've seen people have great success in stocks, and we've seen people take big L's in stocks also, because companies do tumble and they don't do as well as they done previous quarters and previous sessions, etc. Now, with the knowledge that you have out in regards to from a fundamental perspective, and I've spoken to you a few times about this, okay, I think that there are a couple things may suit you, which I'm going to be trying to work with you if you want me to, on, I think, things that play to your strengths. The things I think that play to your strengths there are becoming a little bit more longer term trader, okay, in regards to being a bit more swingy, less looking for the day, more say looking for what's happening from a week to week perspective. Obviously, the issues with that is it does have an impact on the size of, you need a decent size of an account, or if you don't have a very decent size of account, then your lot sizes are going to be quite tiny, so you're not really going to be seeing good big profits after a whole week. That's the issue. I also say this to you, is that I'd like you to start leaning just generally and understanding this market here, this area here, which is your futures
Yeah,
market.
yeah.
All right. So a few reasons for that. So futures is actually a regulated market, as in it's a lot more regulated and a lot more transparent, might be a better word to say, than Forex. See, with Forex, it's like you've got a lot of different middlemen, and all of those areas have spreads and slippage, and this company does this, and some things, the numbers and something. Futures is very transparent, and futures is more say like that's the price of hog meat, that's the price of hog meat. Do you understand what I'm saying? Yeah, and it's exactly the same, as in bar slight nuances, which I think maybe we'll go over one session. And the normal kind of the nuances is certain pairs are going to be looking different to you when you're trying to search them in your brokers. You have to put in slightly different ticker symbols, because the futures market is done by contracts that roll over month on month, and each one of these months, like if you wanted to see like a whole continuous chart in your MT5, you have to write it in a certain way, which is essentially stitching last month's contract to the months before to the months before. It's a slight nuance change. But the point is that you can now then remove an additional variable and start looking at things a bit more fundamentally weighted and just say, I'm looking at gold. Now, obviously, we know the US dollar has an impact on gold, but from a volatility perspective, you're just looking at gold. Do you understand what I'm saying? Yeah. And you can also start looking at something called, what's it called? Is it the COT? Is it COT or COP?
CTO? Is it CTO?
Let's have a look, because this is COT. Oh, is it COT? No, it's not COT. Is it CTO? Don't think it's CTO. It might be COP. COP. No, I don't think it's COT, Sorry, this is holes in my knowledge. There you go. COT. That was correct. The commitment of traders. Okay. View historical commitments of traders charts for commodity futures with weekly data. Now, what is this? Basically, in the futures market, they have to publish the amount of traders, the amount of people that are buying certain things. All right. Now, it just, for somebody who is especially fundamentally poised, like fundamentals, like numbers, analyzing stuff, it just gives a slightly additional insight, completely transparent, of what's happening in the market. Now, I think what we're going to do, I think I want to try and, afterwards, we're going to try and watch something about this. So I don't want to just, I hate to talk on things that I'm not fully versed in, all right? But though you can see it's in my knowledge base, I need to touch up and rebadge. But either way, the commitment of traders COT reports provide a breakdown of each Tuesday's open interest for markets in which 20 or more traders hold positions equal to or above the reporting levels established by the CFTC. The commitment of traders COT charts are updated each Friday at 3 p.m. So the commitment of traders information is available with both the disaggregated and financial traders report. Bar charts recently added, even when we're going to watch something, I think it'd be good to watch something to get a little bit of insight into it. Now, the point I'm making to you is this. Everything that you've learned there, Al, makes you a fantastic trader in any markets, because we're looking at market structure and price action. Okay. And like I said to you, longer term trades are less volatile and more based upon how we can take outlooks and see certain things. Like we're here on a 5-minute time frame, but ultimately, I want to show you something. Ultimately, this is Euro JPY. Ultimately, Alan was saying to me, that the Japanese have been very dovish in regards to their interest rates, even though we know for the longest time that maybe they may have to increase them because their currency is a hot mess. They've been very dovish. So that dovish energy is essentially a bullish signal for, markets that are paired with the Japanese yen, i.e. Euro JPY. Or better still, if you want to see more euros all over the place, USD JPY. Do you get what I'm saying? We know that that's quite of a bullish energy for it. So this is something there whereby, as well as your day trading out, you could be here taking longer term positions, just turn around and say, I'll tell you what I'm going to do. I don't mind putting 1,000 quid. I don't want to make it sound like that, like you're just hedging your whole 1,000 quid, but I don't mind taking a longer position. You could have been down here at the bottom of this range in January and been like, they're just so dovish, and this is so, they're not, we know that there's a potential for that to happen, but we don't think it's gonna happen because the Japanese want people buying from them. They want to keep their economy, that part of their economy very buoyant. And I'm gonna just, place a little stop outside of this low over here. And I'm going to take a long-term position in Euro JPY. Yeah. Or sorry, this is Forex from a Forex perspective, but even on futures perspective, let's go to futures. Yeah, you can the USD JPY future. Sorry, I was looking at the one in the first, but you can look at the future or just the Japanese yen future. Yeah, I think it's something that you should look into.
Yeah, it's room for scope. Yeah,
It's room for
definitely.
scope because it's not a
Definitely.
huge learning curve. It's just understanding that, wait a minute, futures and options, but the options are slight different nuances, but definitely the futures, stocks are all very similar. And more importantly, a slightly longer outlook, longer term view on things. And all that would mean to you is that you're not going down to smaller time frames. You might just stop at an hour for your entry. All right. So you might be here looking at markets. So let's go here. And this is just generally in regards to even Forex for yourself. You might turn around and be like, okay, I'm trying to find an example in my head. But let's just say, for argument's sake, UJ in Forex, and you're thinking to yourself that with what's going on, you can still you have an outlook that the US dollar is still going to get stronger, and the Japanese yen is still very dovish. And you're like, listen, I want to continue buying this market up into these levels. You just means that you're going to be looking at it from a daily perspective, saying right now, okay, Jay, we are in a discount on the bottom of this yellow line over here. Let me get rid of some other distractions. And I can't see anything changing. I think this might even push up even further towards this orange level. And you're going to be getting your entries maybe on hour candles. Yeah, you're going to be turning around and saying, okay, on this front here, for argument's sake, it's not a great example, but you might say this is a big indication. This is a big correction coming down and closing up some of this imbalance. And you're waiting for a closure above this high for you to take an entry. This is going to be your entry over here. Your stop's going to be below this swing low on the basis that you are trying to take that trade, which is not going to happen in quickly, back up into these equal highs over here and hopefully beyond. Now, though that's a 1 to 2 trade, because it's not breathtaking, if you start seeing you being able to take some of these longer term trades successfully, it can mean a few things to you. It can mean that A, that's how you want to trade, just a bit more patiently. B, you may up your risk, on much longer term trades. So you might turn and say, I don't mind risking, I don't know, 5% on this one trade because it's going to be the only one trade in that account that you're going to take, for the rest of the month. And that might push all the way up in here and you've got a 1 to 2.5. Now, sounds like fraff on a smaller level, but let's say for argument's sake that somehow you was able to take that trade and, I don't know, let's just say you even risk 200 quid. Well, that's another, what's that? Let's just say 500-600 quid coming in of a trade that you just had running in the background that you was very confident about because of you looked at it on a lot longer term. It's a lot calmer trade. And let me tell you one thing which is good about it is that if it starts to do something structurally that you don't like, you can stop yourself out early. Like you're not expecting this trade to come down and break this structure. If it does and you don't like the energy or there's some new news coming out in the world, you heard that the Japanese yen, they're very hawkish about moving, you can say, you know what, I'm going to get out of that trade early because things have changed from a fundamental perspective that might mean that this market starts to do this. It just gives you a little bit more time, a little bit more leeway, and a little bit more, general consensus of what these markets are doing. Yeah, so something to think about. Yes, it does affect your lot size. Yes, 100% it does.
Yeah. No, yeah, it is something to think about, and definitely I will think about, and we'll touch base for sure.
100%.
Because there's a lot of news. I used to just have red folder news, but I've got all news now.
And then it gets to information overload. You've got all of this news here. This news could be bullish. This news could be bearish. But I think if someone like yourself zooms slightly out, you might be like, whether it's bullish or it's bearish, the Japanese ain't getting hawkish on their interest rates anytime soon, so I don't care. I'm still going to be bullish on this market.
Yeah.
You can only take that perspective when you're on a larger time frame with a larger stop loss, because on a short term, that news is going to affect your market, your trade, and you are going to get stopped out. And the only thing is, you're going to look at it next week and be like, I knew it was going up. But that doesn't help you when you just get stopped out.
It doesn't. But as you said, there's lots of nuances in this, and you pinpoint there's a number of things that make the market move. Yeah, even the low value, there's treasury sale. When they sell treasuries, the Americans, they normally do it at 6 o'clock our time. It makes the indices moves. So there's a number of things, and it's just about pinpointing, and understanding what makes moves. Also, sentimentally, stuff moves when you've got the James Dimmons of this world who are talking about stagflation and so on and so forth. So that makes sense, and we'll touch base on that definitely.
All right, thank you for that, guys. Well, look, I've seen the time. What I'm going to do is I'm going to play a video. Yeah, I'm going to play 2 videos. I'm going to play a short one, which is COT report explained, and then I'm going to play a longer one by a black guy. I've never watched it, but it says the commitment of traders report explained in detail. All right, so we'll play that. One's only 20 minutes, but I'll play first of all on a short one, which is a minute and a half. Which is 9 minutes, and then we play the other one. Just to give a little insight, guys. And like I said to you, what I was saying, I was talking to Alan, but generally, whether you're trading futures, forex, options, stocks, it's all the same arena. It just depends what tickles your fancy and what type of capital you have. For example, if you want to trade stocks, you've got to have money, guys, because it's a zero sum. There's no leverage. You can't go and buy 80 pence. Well, you can, but it makes no sense you're going to buy 80 pence worth of, Apple stock, because 80 pence worth of Apple stock is 80 pence worth of Apple stock. Whereas, your 80 pence in the Forex market has leverage. It is multiplied by a certain leverage amount, whether that's 1 to 100, 1 to 500, which allows you to get in and out of the market and benefit from the volatility of the market. Okay. Whereas in stocks, that's it. Yeah, you got £100 to invest in companies. You got £100 to invest in companies. It's unlikely that £100, unless something really dramatic is going to happen, is going to turn into, £1 million, because it was only ever £100. Whereas in the Forex environment, depending on what leverage you have, you control a lot more capital, which allows you to get into markets that are bigger than what you can manage. Okay. But either way, guys, let's have a little watch of this if you can do. It's something new bit of education, something to think about. And like I said, we're all about here just developing and learning new stuff. So I'm going to stop the live, because yesterday I had the live playing for hours by accident.